Does it matter which investments you hold in your retirement accounts versus your taxable accounts? Is there a tool that will evaluate your asset allocation plan? And how should you react to market losses? We'll answer these questions and more on the 32nd episode of the DoughRoller Podcast.
Welcome to the DoughRoller Podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Hey everybody, it is day 25 of the 31-day money challenge. This was the crazy idea I had to do 31 podcasts in 31 days in the month of January to kind of help everybody start to kick off the year right when it comes to money. We've covered a little bit of everything. We're coming towards the end of the section that I've put together on investing and probably spent the most time on this topic as opposed to any other. I think we've probably spent about a week's worth of podcasts on everything from how we should think about investing to asset allocation plans to picking investments. We've had some great interviews, including Larry Swedroe and Carl Richards. Have another interview today. So it's been a lot of content because investing is just so critical. We had Brandon Turner on the show too, who talked about real estate investing. It's not all just about the stock market and the bond markets. So tried to cover a little bit of everything. And today we're going to kind of finish off the investing section with an interview with a fellow named Simon Roy, who works at Jemstep. And they have a very interesting tool, very sophisticated tool that can evaluate a portfolio, which we'll get to in a little bit. Also going to talk about how we should react when the stock market goes down. If you've been following it, it was down yesterday, about 2%. The headline was that the Dow suffered its worst week since 2011. So we're going to talk a bit about that and interest rates. And have a reader question about peer-to-peer or person-to-person lending, which may be new to you, but we'll talk about that as well. So I want to get to it. Let me first say thank you to our sponsors, two sponsors who helped me put together this 31-day money challenge, helped make it possible. And the first is Betterment, an online platform that invests your money in both stocks and bonds. They invest in ETFs for you. You just select the percentage you want in each, and Betterment does the rest. They rebalance your portfolio for you automatically. They reinvest your dividends automatically. You can check them out at betterment.com. And then Personal Capital, which is a free online tool. You can connect all of your investment accounts, retirement and non-retirement. You can then track how each account does, how each individual investment does, their performance on a daily, weekly, monthly, yearly basis, whatever you want. You can also see your asset allocation across all of your investments, as well as the fees that you're paying. You can check them out at personalcapital.com. So with that, I want to dive right into it. The market was down. It was down the day before by about 1%, and I even mentioned that in yesterday's podcast. And then yesterday it was down. Let's see, the S&P 500 was down over 2%. The Dow was down over 300 points. It was definitely a day in the red. And one question I have for all of you is, when this sort of thing happens, how do you react? Does it worry you? Do you ignore it? Maybe you're happy because you think I can buy investments cheaper now. It's a funny thing. You can imagine the scene in Money or any financial site. Think about this in the terms of products we buy every day, like at the grocery store. Oh no, bread is down 10%, 10 cents. Eggs are down 25 cents. This is the worst a decline in food costs in 4 years. Well, it would be kind of goofy, right? It would be goofy because we'd cheer the fact that the things that we buy every day go down in price. But when our investments go down, it just is it's a different feeling. Even though we can now invest in stocks for less money than we could the day before, somehow we get that feeling in the pit of our stomach that our futures are in jeopardy. And it's not I kind of chuckle just because I think I chuckle at myself as I, deal with my own emotions and the market. I've come to a point though where, the last couple of days just don't really faze me. One thing I will say that I do though, when I know the market's down, I normally don't log into Personal Capital to check my balances. I know that they'll be down, and I just kind of wait for a good day, and then I check them. But I'm curious how you react, and feel free to email me at dr@doughroller.net and let me know. I'd be curious, if there's anyone out there that's kind of afraid right now, and you're thinking of selling. Or maybe you're at the other extreme and you're happy the market's going down and you're thinking of buying, or maybe you just don't do anything. Or maybe you're not investing right now in the stock market, and this is why, because you're scared that you'll lose some money. I'd like to hear from you and how you react to market declines. What I do, as I said, it's true. I don't check my balances typically when the market goes down. That's a little less so today than it used to be. There was a time when when the market was down 1 or 2%, I would not look at my balances. I just figured, I don't want to sell. I'm not going to sell. Why look at the balances and see that I've lost, however much money well, actually, it's not fair to say I lost it, but my portfolio is down. Why look at the ugliness? Today, I still do that, but maybe not as much. It doesn't quite faze me as much. When I look at this, I look at some individual stocks that I invest in, and I wonder, if the price goes down far enough, I may want to buy more. That's what I did with Apple last year when it was under 400, and now it's in the mid 500s. But it was down almost 2%, like most other stocks yesterday, and Apple's down 2.66%. I'm looking this up now for the year. It's at $546. I still think it's undervalued, but obviously not like it was a year ago when I bought it. And, I look back then and I think, man, I should have bought more, and I knew I should have then. And it wasn't because I thought the price would go to where it is today. I had no idea where the price would go or when. But I believed it was undervalued. And anyway, so when the market goes down, that's kind of how I think. Are there investments out there? Could be ETFs, could be mutual funds, could be individual stocks. For me, when I see the market decline, I'm more focused on the few individual stocks that I have. Can I snap up some more at a bargain price? That's how I react to the market. I don't do a lot of trading, though. I have a brokerage account. I have a Scottrade account. I'm going to be opening up an Options Express account, which I'll talk about and the reasons for that in February. But I don't do a lot of trading. Last year, the Apple stock that I bought was the only individual stock that I bought last year. Actually, I already had a position in it, so I just increased my position in Apple. But that was it, only one. Other than my IRA, my SEP IRA, which is an IRA for self-employed folks. I contribute to that every year. And last year, I bought more Apple for my SEP IRA as well. But I don't do a lot of trading. But when I see the market go down like it has, I'm always looking at the stocks that I've invested in to see if I can add to them. I don't like to. With the individual stocks, I tend to keep the number pretty low. I think I have 4 or 5 right now. 4, I guess. I don't like to have 10 or 15 or 20 stocks. It's just too much to track. And my portfolio as a whole has plenty of diversity. Anyway, so I'd be curious how you react to the market. Hopefully you're sticking to your asset allocation plan. I know I am. Haven't sold a thing. Have no plans to do so. Haven't changed my asset allocation plan. But that does get me to another topic, and I've been getting a lot of email and comments about this, and that is interest rates. I do think we are in an interesting market because on the one hand, you have bonds and their prices are very high right now, which is just another way of saying their yields or their interest rates are very low. And we know that as interest rates rise, the value of existing bonds go down, right? Because they're at lower rates, assuming that they're at fixed rates, which most bonds, not all bonds, but most are. So, we're kind of nervous to invest in bonds because we all expect interest rates to go up. And, if we do invest in bonds, we tend to stay with shorter term bonds with shorter durations because they don't get affected as much by rising rates as do longer term bonds. And that makes sense. If you're stuck in a 30-year bond at a very low rate and it goes up and the interest rates go up, well, you're stuck at that lower rate for a very long time. as opposed to a bond that has a duration of just a month, let's say, or a year or a couple of years. But, we're sort of scared to wade into bonds, and I've gotten a lot of questions from readers about that. And then in terms of stocks, they've been down this year so far, but, not that much. I mean, most kind of view the market as overvalued, not as much as it was, say, in 2000, but we're kind of approaching valuations that we saw in the 07-08 time period. So that makes, wading into stocks, a little unnerving. And then, you've got savings accounts that are at, less than 1% for an online savings account. So that's not very exciting. It's like, where do we go? What do we do with our money? And of course, one answer, I think always, for me, a good answer is you just stick with your asset allocation plan. For now, things, may not be that exciting. There might not be as many deals out there. But, if you're investing for the long term, does it really matter? I've at my age, I've still got 20 years to retire. So, what happens this year, the next 5 years, really in long term, it's just not that important. So I think that's, one approach, but the question then still is, but is there anything else we can do? For me, one of the things that I mentioned yesterday that I'm focused on is paying off my mortgage early, which for me will be a guaranteed before tax return on my money at 4%. And obviously that's lower than the long historical return on stocks, and I understand the argument about taking that money instead of paying extra on the mortgage, put it in the stock market. But I like a no-risk 4% return, and I like the idea of having my mortgage paid off. But that being said, if you've listened to my other podcasts, you know that I rarely look at finance decisions in black and white. People will ask me, they'll say, so should I pay off my mortgage early or should I invest in the stock market? And my answer to that is yes. Do both. You don't have to do one or the other. And that's my plan. I'm going to roughly take 50% of the extra money we have each month. Some months it'll be very little. Other months it might be more. But whatever it is, I'm going to take about half of it and pay it towards the mortgage, and the other half and put it in our investments. For the most part, it'll just go into our investments along, based on our asset allocation plan. As I said, if I see what I think are some really good buys on individual stocks, I'll do that as well. And by the way, I've not really focused a lot on investing in individual stocks during this 31-day money challenge. And the reason is because I think for the vast majority of people, one, they don't invest in individual stocks, and two, there's probably no need to. You get a great, portfolio of low-cost index funds, and I think that's perfect for the vast majority of people. Frankly, it'd be perfectly fine for me. There's a whole story as to why I started investing in individual stocks. But I say all that to say that in upcoming podcasts and in upcoming content on the blog on DoughRoller.net, I'm going to be walking through what my investments are in individual stocks, how they performed. I've got a post planned in early February for how they performed in 2013. They did not beat the S&P 500, although they did very well. But I can tell you they did not beat the S&P 500. And I'm going to walk through how I evaluate a company. I've spent a lot of time in my career reviewing financial statements and the audits of financial statements. And so I kind of use that background to evaluate companies and pick the stocks that I think are undervalued. That's always my goal. I don't ever go for the growth stocks, like the high flying stocks that are popular that have insanely high PE ratios and that sort of thing. That just isn't my approach. But I will be talking a lot more about that and writing about it after the 31-day money challenge. And that brings me to one other quick topic, and that is, before I get to the reader question, I was having lunch with a really good friend. He's a CPA, very bright guy. Could tear apart a financial statement, and very good at evaluating them for signs of fraud, and really talented accountant and auditor. And we were talking about investing, and I said, so, where do you keep your money? And he told me it was one of the big brokerage houses. I won't mention who it was. It doesn't really matter. I said, yeah, so what do you invest in? He goes, well, they invest for me. I said, really? I said, well, what does that cost you? He goes, about 1.25%, I think. I'm like, what? You really need to listen to the 31-day money challenge. I said, well, why do you do that? And he's like, well, it's just, it was easy. It just, I didn't have time to think about it. And he goes, I'm slowly moving to index funds because they are cheaper. And I said, well, you really need to get on that because that's going to kill your return. I said, well, what do they invest in? And he said, I think they invest in like 20 or 30 mutual funds. I'm like, holy cow, why in the world? What's the logic of that? I mean, some folks tell me my portfolio is a bit complicated, but I've only got about 10 funds, 20 to 30. So it was an interesting conversation because here's someone who is very sophisticated, and he's paying what I think anyway is a lot more for his investment. So I told him I was going to have to do an intervention, come over to his house. We're going to sit down, get this taken care of. He's a good guy, but he didn't take me up on that offer. But I think hopefully he's working on that. I told him that when we have lunch again, we have lunch about once a month. If he hasn't fixed all of this, he has to buy. And if he does fix all of this and he gets his money he out of the hands of this money manager, and he manages it himself in low-cost index funds, which he is more than capable of doing. We all are, in my opinion. Lunch would be on me, so I'll report back in about a month and let you know how he did. Okay, quick question from a reader named Chad. This was actually a comment that he left on the blog. He says, thanks for the work you do. I was curious what your thoughts on person-to-person lending, i.e. Lending Club Prosper. In your opinion, is it a good or bad investment? And if good, what percentage of your assets would they hold in your asset allocation? It's a great question. So first of all, what is person-to-person, or sometimes it's referred to peer-to-peer or P2P lending? And the two big websites in this space are Lending Club and Prosper. So what is it? Well, these companies basically put the borrower and the lender directly together. So rather than the borrower going to a bank to get money for a car or to refinance credit card debt or to start a business or whatever, they can sign up for Lending Club and Prosper, and the two companies will gather a lot of information about the individual, why they want to borrow the money, how much, their credit score, all this information, and then investors can bid on it's actually not a bidding system anymore, but they can buy into this person's a loan to this person, and it can be a small amount. I mean, for example, the person might want, let's say, $5,000. You don't have to invest $5,000, and in fact, most of the time you wouldn't do that. You might only buy $25 worth of notes to this individual, but hundreds of people do that, and that's how they fund the entire loan. And again, you just own a small sliver. But the way it works is, just say you invest $1,000 with Lending Club. And you can automate this process and let Lending Club select the investments for you. But you might have, $25 or $50 notes for each borrower for your entire investment. So with $1,000, you might have 20 or more different notes to different borrowers to diversify. And you can pick borrowers based on their credit rating. And of course, as their credit rating deteriorates, the interest rate you'll get goes up to reward you for that additional risk of default, right? And default is absolutely a very, very real thing with Lending Club and Prosper. So that's kind of what it is. And I will leave links to some articles I've written in the past about both in the show notes. And I do invest in Lending Club and Prosper notes. I don't think of it in terms of asset allocation, though. In fact, it's not part of my asset allocation plan. I have very, very little money. I have about $1,000 in Lending Club and less than that in Prosper. It's interesting. My Lending Club net annualized return right now is 2.77%, which is just awful. It's actually been as high as 15 to 20%. And then I just had a string of defaults. That's a good lesson. This is peer-to-peer lending is very high risk. I don't care if you invest in the most creditworthy borrowers on either platform. This is high risk lending. All right, this is not. I view it as high risk regardless of the type of notes I buy into. Now, some of them are more higher risk than others, but I think all of it is high risk. Now, with Prosper, my return is a little better. It's just under 10%. What I'm actually going to start doing, I'm going to fund both accounts up to exactly $1,000. And this is one of my other plans for February. And I'm going to start just keeping a sort of month-to-month update. I'll do an update post with my experience investing in each and how I'm doing, mistakes that I've made. It's an interesting. I kind of do it for fun as much as anything else. I would never make peer-to-peer lending a significant enough portion of my asset allocation plan to actually have it in my asset allocation plan. I just, there's no need for it, number one, in my view, and it's high risk. But I think for relatively small amounts of money, I think it's perfectly fine. I have a lot of fun with it. I do know people that invest quite heavily in Prosper and Lending Club. So, you need to do your own research and decide what's best for you. But I would not, if someone said, "Hey, you want to put 5% of your portfolio in peer-to-peer lending," no, I absolutely wouldn't. I think the most I've gone up to is $2,000 or $3,000 in the account. And but like I said, I'm going to top off my accounts to $1,000 each. Lending Club's almost there already. Yeah, it's $930.42. So not much to add there. Prosper is a little lower, so I will top those off and kind of doing a monthly update throughout the year as to how I do. And as I said, I'll leave links in the show notes to some articles I've written about both. You can check it out. In terms of now that's all of that's in terms of an investor. As a borrower, it's unsecured debt. If you have a good credit rating, the interest rates can be single digit. If your credit score is not good, you're likely going to have interest rates in the double digits. So as a loan, is it a good option? Well, again, keeping in mind that our goal is to avoid debt, but as debt goes, it can be a good option for some people. I know they've been able to find capital this way where they couldn't in other more traditional means, and got what they thought was a reasonable interest rate. So, the theory is it takes out the middleman, the bank, and all of the fees that the bank would collect. Of course, Prosper and Lending Club collect fees, so it doesn't really take out the middleman, except that perhaps it takes out some of the fees that sort of a traditional bank might charge. And so there, it brings the borrower and lender a little closer together in terms of what the lender makes and what the borrower pays. But it's not without fees. So, I think it's an option. I'm not a cheerleader for peer-to-peer lending. I don't think it's good or bad. Is it a good or bad investment? It's an investment, I guess is how I would put it. But it's certainly not going to be something that's going to be a major part of my asset allocation. But I've invested in it for a number of years. I kind of have fun with it. I enjoy it. And it's returned money. I haven't lost money. Even with Lending Club that's down under 3%, I've still made money. And now, of course, you might say, well, 3% is not bad when you compare it to a savings account. No. Do not compare P2P lending with a savings account. They're two totally different investments with totally different risk profiles. There's absolutely no comparison at all. Okay, so that's Chad's question. And so now I want to turn to the interview. This is an interesting interview. Jemstep is an online tool that will slice and dice your asset allocation for all of your investments and then recommend changes either to your asset allocation and then to the specific investments that you have that implement your asset allocation plan. And it's a very sophisticated tool. As you'll hear in the interview, when it looks at what you might want to sell and then buy instead, it's looking at things like where you're holding the investments, taxable account versus a retirement account. And the basic theory there is for investments that give off a lot of interest and dividends, think REITs and bond funds are two examples that give off a lot of taxable income each year. You generally want those in your retirement accounts, which are tax deferred, right? And those assets that don't give off as much taxable income from year to year, you want those in your taxable account. Right? In the long term, there'll be capital gains eventually, but that's only when you sell, right? So it looks at that. It looks at the cost of each investment, obviously focusing on low cost. It has a very sophisticated engine to pick what it thinks are the best investments for each asset class. You can ask it to just focus on mutual funds or ETFs or both. Very, very sophisticated tool. And I think, I learned a lot from looking at it and hooking up all of my accounts and studying what its suggestions were. I didn't buy into all of its suggestions, but some of them were very helpful. It's like any other tool. I think you use it, but you always have to make up the decision that's best for you. Never just rely on a tool or a calculator. I guess I've said that time and time again, or what I say or something else you read on the internet. Question everything, right? But that being said, a very sophisticated tool that I think could teach us a lot. So with that, let me turn it to the interview. Simon, welcome to the show.
Thanks, Rob. Good to be here.
I appreciate you taking the time to be with us today. Investing is a pretty important topic to a lot of the listeners to this show and readers of the blog. And I've spent some time with Jemstep's tool and know that it's a pretty good and robust tool to help folks. So looking forward to this interview. Why don't you just kind of give us a little bit of sort of your background and what you do at Jemstep?
Absolutely. So I'm president of Jemstep. I've been with the firm for over 4 years. And as a little bit of background, I worked in financial services as a consultant with McKinsey and got to see the industry a little bit from the inside out. And based on that experience, was really keen to find a way to demystify finance for the average investor and really help them make sense of the complexity that is often presented to them. And so based on that background, spent a good few years in technology startups on the West Coast, got involved with Jemstep, whose mission is to help individuals and help guide them in terms of how to best invest for retirement, how to make sense of their current circumstances, their current investments, and really help them make better decisions so that they can have more secure retirement golden years that we all aspire to.
Yeah, and Jemstep was kind enough to give me access to its portfolio manager, and I've spent a lot of time with the tool, and I want to dive down into some of the details. But perhaps we could just start off. Could you kind of give us a high level view of what the Jemstep portfolio manager does?
Yeah, so we model Jemstep Portfolio Manager after the classic wealth management service that one would get if one went to a advisor with $5 or $10 million. So the basic service replicates that process that you would go through with a high-end, high-net worth advisor, and starts off by asking a few questions of investors when they log into the web service about how old they are, when they'd like to retire, whether they have a spouse or a partner. And so a series of questions to understand who they are, what they're aspiring to. And based on that, we start building a model as to what the individual is projected to have in retirement. So that's the first step, better understanding the individual, their circumstances, and their preferences. The second step is to understand what does the investor currently have invested. So what have they saved, how are they currently investing, and what are the accounts that they're in? And we give the investor an option of either bringing in and linking their accounts so that we have access to just the information of what they hold, or they can manually enter the holdings if they prefer that. Based on that, we then project, in the third phase, we project what they're on track for in retirement in terms of how much money we believe they have to spend each and every year. And then we give them an optimized allocation, an optimized set of recommendations, and show them how much more, or perhaps less, they might have in retirement with that. And that then is used to guide them to, we hope, a better outcome. But effectively, we translate that asset allocation into a set of specific buys and sells in every one of their accounts, including 401ks, including IRAs, and brokerage accounts, so that they, in going through the Jemstep process in 10 or 15 minutes, will have specific recommendations that, if they act on, should help them reduce their fees, reduce taxes, and set them on a better path towards retirement.
Yeah, and I think, just so I understand and those listening do, this tool is a lot more than just taking a look at the investments that someone has and understanding the asset allocation for those investments and perhaps the fees they're paying. I mean, the Jemstep tool actually then suggests, and we'll get into some of the details, but it makes recommendations. You should sell these investments and you should buy these investments. I mean, it's very specific recommendations. Is that right?
That's exactly right. Jemstep is a registered investment advisor, so registered with the Securities and Exchange Commission. And we take a fiduciary responsibility towards the client, so we put their interests first. And part of that is to ensure that we can make very specific, personalized recommendations. So this isn't generic one-size-fits-all. It's, as you say, it's literally looking at your specific circumstances, your age, how much you saved, what you have in your accounts, what the tax status of the accounts are, what is the best allocation for you, or at least an optimized allocation for you, and then specifically in each account, how many of each share or mutual fund or exchange-traded fund to sell, and how many of specific funds to buy to shift you from your target to from your current to your target allocation. And what we've done, we have 3 issued patents on our technology, which we've been refining for 5 or 6 years. And what it does is it looks at the fund fees of your current holdings and of the ones we recommend. It looks at the quality of the funds across 50 dimensions. It looks at the taxes embedded in your current holdings in taxable accounts, whether you have capital gains and losses, and it considers which accounts different asset classes are best held in, meaning, should I hold my bonds in my 401k or my taxable account? Looks at all of those factors and then comes up with these very specific recommendations incorporating the fees, the fund quality, and the taxes, so that we're making recommendations that are optimized for your circumstances with the goal of guiding you towards, lower fees, lower tax bite, and, a more optimized allocation through to retirement.
Yeah, and the tool does so much, and you've listed a number of things. I kind of want to walk through this because I think each of these items is extremely important for folks to understand, whether they end up using Jemstep's tool or not. It's important to understand things like how taxes affect your investing decisions, asset location, fees, and all of that. So to try to do this in a somewhat, logical fashion, I want to start at the beginning. And you had mentioned that when you use the tool, you can input some basic information about yourself and whatnot. And I've done that, and in fact, I'm looking at my profile screen now. You can enter information for yourself or also for a spouse, which is what I did in my case. And you include your age, your current age, the age you want to retire, your gross annual income, how much you save for retirement. And then one of the things that Jemstep does is calculates an expected annual Social Security benefit. And then it gives you what Jemstep calls investment preferences. And in my case, I guess this is the same for everybody, but I could check off one of 5, risk profiles, whether I'm a conservative investor, moderately conservative, moderate, moderately aggressive, or aggressive. And this is not unusual. I've seen this in a number of tools, but can you kind of describe for us how that works and how someone should go about making that decision? Because I assume it's going to affect things like Jemstep's recommended asset allocation as we work through the tool.
No, Rob, that's exactly right. I think one of the toughest things for investors is to decide and accurately indicate what their risk tolerance is. And, we've all been through some tough market circumstances, 2008, 2000, and, we respond differently to perhaps how we thought we might to those circumstances. And so what Jemstep is looking for from the individual is to give an indication of where they see themselves on the spectrum of, really conservative to reasonably aggressive. And we take that indication and we match that with the time horizon that the individual has to the point of retirement, and actually a little bit into retirement as well. And what we do is we combine those two to, provide a more accurate view on both their willingness to take risk, so their stated risk preference, and their ability to withstand the ups and downs of the market. And what I mean by that is the longer the time horizon, the more the individual's ability to withstand market ups and downs, over the 10, 20, 30 years to retirement for retirement assets. And so if an individual comes in and says, I'm generally conservative, if they're 22 years old and they say they're generally conservative, we will shift them a little bit towards the more risky because they're so young and really should be more exposed to assets that have a high probability of growing, such as stocks as opposed to bonds. If they're 65 and they say, hey, I'm pretty aggressive, we will moderate that a bit because they're close to retirement, and the consequences of the market downturn at the wrong time for them are greater than they are for a 22-year-old. And so we're looking for an indication, and then we use that married with a time horizon to assign them a risk level, and as you point out, that's what we use to help determine what the appropriate asset allocation is for them given their circumstances.
So the asset allocation that you'll recommend for an investor, while it's based in part on their own sort of self-assessment of their risk, their tolerance for risk, that's not the only factor.
Absolutely. And that's exactly right. And the second thing I will mention is we also have embedded in the service a concept of what's commonly known as a glide path. And so the initial portfolio that we give, for example, to the 22-year-old will slowly be transitioned. They'll slowly be transitioned as they get older to less conservative, less aggressive portfolios as they get closer to and into retirement. And so not only is it a function of those two factors, but it is adjusted as circumstances change.
And did you call that a glide path?
Yeah.
Okay.
Yep.
And then below where you can select, and by the way, for those listening, I'll include some screenshots in the show notes to this episode, but we'll also include links so that you can check out Jemstep for yourself. I know sometimes it's difficult, or it's easier to follow all this visually, but below where I can select my risk tolerance, the tool asks me what types of investments I prefer, and the choices are mutual funds versus exchange-traded funds. And I selected both in my case because I have both. I don't know that I probably do. I probably prefer mutual funds, frankly, even though I know ETFs can sometimes charge a lower expense ratio. But Simon, I'm curious, from Jemstep's perspective, is one vehicle generally favored over the other?
The short answer is if we had a bias, it's probably more towards exchange-traded funds because they tend to be more tax efficient and in many cases lower fees, and we rarely see the impact of fees when we run these analyses. But it really is a function of the individual's preference. Some people don't have the experience or the confidence yet in ETFs, exchange-traded funds, and so they're just as well served with mutual funds. The goal is, and our goal in providing advice on both or either, is to fit with the individual's preferences and be able to give them quality of advice, irrespective of what their personal preferences are. And, to support that, Jemstep, it's worth mentioning, we track 38,000 mutual funds and exchange-traded funds on a daily basis to be able to provide that level of flexibility and quality of advice. The goal ultimately is to fit with our consumers, with our clients' needs, and give quality of advice based on that.
Okay. So once I filled out that sort of profile page, I then brought in all of my investments. And as you mentioned, earlier, folks can either enter their investments manually or they can provide the login information, and Jemstep will go out electronically and retrieve the information on someone's investments and pull them into the tool, which is what I did, and it took me just a couple of minutes, and it all worked without any issue. One of the things that I found interesting in the process is that ultimately this is going to lead to some recommendations by Jemstep on how I might change my investments, and in my case, Jemstep had a number of recommendations. But when it comes to a 401k, folks are limited. They're limited to the investments that are available in their employer's 401k, and that's of course true with me as well. And as part of bringing in my portfolio, Jemstep asked me to enter the investment options that are available in my 401k. And that process was painless, really. I mean, it didn't take but a couple of minutes. I think the 401k I have, I'm not sure of the number, but maybe it has 20 options. But can you tell us a little bit about how that works in the tool and how Jemstep deals with the limited investment options in 401ks?
Yeah, Rob, the principle, firstly, we designed Jemstep as much for ourselves. It's an issue that we were trying to resolve for ourselves, and we certainly hoped, and based on conversations, believe that many others had it as well. And the basic issue that we were facing, and I think many Americans over the age of 20 are facing, is they just have multiple accounts at multiple institutions. They have 401ks attached to their companies, their old companies, their spouses and partners' 401ks, IRAs, brokerage accounts, you name it. And it's very hard to make sense of all of these accounts when they're scattered all over the place. And it's damn near impossible managing them as a portfolio of accounts, let alone managing any one of them as a portfolio in and of itself. So a core premise behind Jemstep and a core part of our value proposition to investors is to work really hard to give them the ability to manage their full set of accounts as a portfolio, irrespective of where they're held or what the fund constraints are in those accounts. And that's something that I think is of great value and can really end up leading to better outcomes for investors. And so given that 401ks and 457 plans and other retirement accounts were a major focus for us, but are typically very hard to get information about. And so what we set up, as you described, is a way to identify the company that this account is with. Maybe it's GE, maybe it's Google, the specific plan it's assigned to, the 401k profit sharing plan, and then provide the first individual who enters that plan the ability to either enter the fund details if they have a limited list, as you described, or they can actually just email or fax us the funds that are available, and Jemstep will enter them into the system. And so that process, as you mentioned, is pretty seamless, pretty painless, and only has to be done once for any company, and then those funds will be available for all future employees working at that company who use Jemstep. The way Jemstep deals with limited funds accounts like 401ks, so you may only have 3 large cap funds available or 2 mid cap and 1 international. The way Jemstep looks at it is we first look at the asset allocation, and we say how much large cap should you have, for example. Let's say you're underweight in large cap. What we will do is we will look at all of your accounts and say, where is there available money to buy more large caps after we've sold funds that needed to be reduced? And we ask the question, where are the best large cap funds available? So we look at what's available in the 401k. We consider that it's a 401k, a tax-deferred account. And if there are high-quality funds available there and perhaps not in another account, we will select the location that is best for large cap funds and that has the highest quality, lowest cost funds available. And so we seamlessly incorporate a 401k in our recommendations using that, the advice engine for which we have, 3 patents on to select the best funds given the constraints in the 401k accounts that you have.
Yeah, and I take it over time as more and more folks enter the funds that they have available in their employer's 401k. Jemstep basically has a growing database of 401k plans. So if someone is working, as you mentioned, at Google, the information about their plan is likely already available within Jemstep.
Exactly. In fact, to your point, Google is available in Jemstep. And they have a great 401k plan, as it turns out. Low cost funds and a good selection. But that's exactly right. The more people who enter the funds, the more seamless it'll be for the next person from that company. And as you indicated, the service is designed to look at the 401ks, make sense of what's available, and then make recommendations based on that, as well as what's available in all of the other accounts.
And when we get to the action plan, I think you'd mentioned earlier that one of the things that Jemstep takes into account would be the taxes. If investment is sold, are there any tax implications of that? So when Jemstep receives the various investments, whether it's entered manually or automatically, does it obtain the tax or the cost basis for these investments, and how does that work?
Yeah, so Jemstep uses a service, an account aggregation service, which basically, once you give the credentials, will access the holdings in your account, say at Merrill or Goldman Sachs or E-Trade, Schwab, etc., and it'll bring in the holdings, the information about what you currently hold, and typically with that, we will get the cost basis, the average cost basis for those holdings. And obviously, this is only of importance in taxable accounts. And when that is accessed, it means that as Jemstep considers what funds to sell to reduce, for example, if you have too much international stocks or too much of a holding in bonds, in deciding which bond funds to sell, it'll consider is there a capital gains, and all other things being equal, we will tend to sell if there is a loss and try and avoid gains to the extent possible. And so, yes, that is factored in. We also give the individual the opportunity to modify that, cost basis if needed. And so there's a level of customization, personalization that's available, because at the end of the day, you want the investor to be comfortable that we're dealing with their preferences and their specific circumstances. But cost basis and taxes are a big driver of what you end up with at the end of the day, and we want to incorporate that and design it to do that.
Yeah, I'm looking at my portfolio now within Jemstep, and I do see that it's brought in all of the cost basis for my investments in taxable accounts, including a handful of investments in individual stocks that I have. And it does list the cost basis. Good. So once we get that in, now I guess in some ways the fun begins. So we can take a look at the asset allocation, and I'm moving over to that now. And it's pretty straightforward. The tool shows my current allocation. Actually, it's a couple of things. It shows my current allocation. It shows the allocation that Jemstep recommends, and it also makes a projection of how much more money I will have available annually at retirement if I follow Jemstep's recommendations. So my first question is, how in the world does Jemstep calculate that if I follow its recommendations, I'm 47, I put in retirement age of 67, if I follow Jemstep's recommendations, 20 years from now, I'm going to have more money to spend than if I keep my current allocation?
That is a good question, and something we put in a lot of time and effort into developing. And the the long and the short of it is, at the end of the day, what we want to be able to guide people towards is making an informed decision as to whether it makes sense, whether there's an opportunity to perhaps end up with a better outcome in retirement. And so the question we ask, and the question we're trying to help individuals solve or answer is, am I doing the right thing with my money? And if not, what should I be doing? And so that's the question the service is designed to answer, whether you're managing it on your own, your money on your own, whether you're using an advisor or whether you're using an advisor for a portion of your investments. And so in asking that question, you say, well, what would people really want to know to understand and, whether they are on track or not? And what we heard is, I want a comparison that I can relate to. And typically that was translated into, well, I'm earning $60,000 a year now or $160,000 a year now. Tell me what I'm on track for in retirement that compares to that number, because I can relate to that. And so we developed what we call an asset and liability model behind the scenes. And the asset and liability model, in simple terms, think of it as a spreadsheet, a monthly spreadsheet that calculates how much money you're starting with today at 47, how much you're going to save every month based on what you've told us and how much time you have, and then what you're starting with in terms of the assets that you have in your portfolio, all of which you've given us in the first 6 minutes of using Jemstep. And then what we do is we apply what's commonly called Monte Carlo analysis. We basically project the investment returns on the money that you currently have and will save, and use that to project how much money you'll earn through your period to retirement and in retirement. And we use this approach to simulate good markets, bad markets, average markets, to come up with an average projection of what you're on track for. And so that's what we use for your current portfolio. We know your portfolio size, we know your asset allocation, we know the funds and the fees in those funds, and we know how much you're going to save. And we project that out through retirement, and that's the number you'll see on the left, which will say you're on track for $55,000 a year in retirement. And then we assign you to what we believe is the optimized or optimal allocation for you and optimal fund selection. And we run exactly the same projection, looking at the expected returns for each of your asset classes and deducting the fees in the funds that we would assign you to. And we compare the two. And it's worth saying that the Jemstep portfolios win the vast majority of the times or project to outperform, but not all the time. It's less than 10%, but if the individual comes in with a beautifully balanced portfolio, low-cost funds or individual stocks, then we will let them know that they're in great shape and, great job. But what we are seeing, Rob, is that for the vast majority of people coming to Jemstep, there really is an opportunity to improve their outcome, driven by, I think, three things. The first is helping guide them to the right asset allocation. And so that's a combination of risk and making sure they have a well-diversified, balanced portfolio, which is embedded in Jemstep. The second is reducing fees and guiding them to quality funds, reduce fees. And the third, as you mentioned, is very much managing their portfolio to minimize the tax impact. And that's capital gains, making sure that you manage that. And secondly, making sure that we assign people's investments to the right type of account. And those three things, the portfolio allocation, fees, and taxes, can have a dramatic impact on projected outcome. And that's what you're seeing in those two projections.
Right. And I can tell you that in my case, I'll tell you, I'm not part of that 10% who puts their portfolio through the Jemstep tool, and Jemstep concludes they can't do any better for them. There's definitely improvement, at least in the projections based on Jemstep's recommended portfolio. Before we get to the actual plan, which is sort of the last step, though, I have some questions for you about the asset allocation that Jemstep is recommending. And I, of course, this is going to be a little different for everyone, as you've pointed out earlier, depending on their age and their risk tolerance. In my case, I selected the most aggressive of the risk tolerance suggestions and or options, and I've got another 20 years before retirement. And so the allocation was, just doing the math here real quick, looks like about 77% stocks, 17% bonds, 1% cash, and 5% commodities. That was the recommended allocation. At a high level, my current investments were pretty close to that. But I did have some questions, particularly on the international side and the bond side. One is that in the bonds, you do not, or Jemstep does not recommend tips. Is that true for all investors, or is that simply, in my case, because of my age and my risk tolerance, that tips were not recommended? In other words, are there some investors where the Jemstep tool will recommend tips?
Yeah, absolutely. So tips are recommended for individuals who are a little less aggressive than you, and certainly those closer to retirement. So they are absolutely part of our asset allocation. Given what you select in terms of really aggressive and the time horizon you have, we don't include tips in the initial portfolio we assign you to. But over time, as you get closer to retirement, those will be incorporated into the portfolio.
Okay. And then the other question I had, I noticed that in the bond component, there are no foreign bonds listed as an asset class. Again, is that going to be true for all? Is that just peculiar to me because of my particular circumstances, or is that true across all of the Jemstep tool, that it would never recommend foreign bonds for an investor?
Yeah, so we went through an exercise with our internal investment management team as well as external advisors, and what we did is we looked at the set of asset classes that we were considering including in the allocations, and we looked at two factors. One was how familiar is the average investor and how comfortable is the average investor in investing in this asset class, because individuals need to be comfortable, making the trades based on the asset classes. And secondly, we looked at what's the potential impact this asset class would have on the portfolios, on the performance of the portfolios, and that includes the return and the volatility and the risk. And based on that analysis and based on the asset classes we include, we determined that international bonds were not a great fit for the Jemstep client, and focused more on U.S. bonds, as you mentioned, the TIPS, government bonds, corporate, and mortgage-backed securities. So that international bonds are not an asset class that is included in the allocation.
Okay, and you mentioned corporate bonds. I'm in looking at the allocation, excuse me, it has U.S. government, it then has U.S. credit. Is U.S. credit the same thing as corporate bonds?
Yep.
Okay. Then my final question about and maybe this kind of leads us into the action plan, but for someone using the tool, if they looked at this, we'll use international bonds just as an example. If someone said, I like the tool, I like the recommendations, I'm going to by and large follow them, but Vanguard's got a new emerging market debt fund that I really want to invest in. And so they're going to put 4% of their portfolio into that fund. Again, I'm just using that as an example. Is there a way to do that in the context of this tool? How do they deviate from if they want to follow most of the Jemstep plan, but not quite all of it? Is there a way to do that within the context of this tool?
Yeah. At the end of the day, what Jemstep is doing is providing advice. And with any advice, it's ultimately at the discretion of the investor to decide whether they want to follow it or follow it partially or not at all. And so what we basically say is this is our best recommendation for you, but you may have preferences or you may have circumstances which would argue, I want some emerging market exposure on the bond front. And so what we would say, if you want to modify from the Jemstep recommended allocation, is, go ahead and do that, and in essence, use an allocation for the equivalent bonds in the U.S. and spend them internationally. The bonds have very similar characteristics. The difference, obviously, with emerging and international bonds is you're exposed to exchange rate risk, which is perhaps compensated for, perhaps not, and you obviously have the credit issues around emerging market countries. But in essence, it's a fixed income stream, with some credit risk and an added layer of exchange rate risk. So make the modifications as you see fit, but we would argue stay within the broad asset allocation guidelines that we provide.
So if they wanted to have some emerging market bonds, Jemstep, that well, obviously investors can make and should make the choices that they view best for their particular circumstance. But your point is, if you want to use the Jemstep tool, you still advise staying within, in my case, for example, 17% bonds. But if I want to reallocate within that 17% to, say, get some emerging market exposure, that's obviously a choice I could make.
Absolutely. And, the system is designed to deal with a tolerance around the 17%. There's a level of art as well as science in this. And so if it's 18%, there's a level of tolerance when it comes to building these portfolios. But as you said, we believe you'd be better off living within those boundaries as prescribed by the system.
Okay. Well, let's move to the final step. This to me is really, from my own experience, and I've used a lot of investing tools, the action plan that Jemstep offers to me is really what sets this tool apart. And I'm looking at mine now, and just, for those listening, it literally goes account by account, and it tells you, sell this investment, either all of it or some of it, and if it's some of it, it'll tell you, sell X number of shares, and sell X number of shares of this, and then buy this fund, and then it goes right down. I mean, you just can follow it step by step. Of course, you want to understand what it is you're selling and why, and what it is you're buying and why. And one of the things I like about this tool, Simon, is that it actually tells you there's links next to each sell and buy recommendation that says why ? And you can click on it, and Jemstep gives you an explanation for either the buy or the sell recommendation. That had to have been incredibly difficult to program, I would think.
Yeah, I think from the client perspective, the piece that we felt was absolutely critical to get right, and what we have, invested a very significant number of man years developing is, what I think is best described by one of the clients that we tested this with, and that is the ability to provide the investor with an action plan. And the way the person described it was, okay, now I get it. Now I know exactly what to do. It's designed to give very explicit advice down, as you said, to the share number of every share or every fund we suggest you sell and similarly to buy, and percentages in 401ks, with the rationale as to why, and that includes why from an allocation perspective, as well as the whys from why this is the best fund to purchase or the best fund to sell, and that could be fees, risk-adjusted return, you name it. Very, very high level of granularity. And the goal is to enable people to get comfortable with what it is we're recommending so that they're able to take action and get on with their lives. So behind this and driving it is, as I mentioned, 5+ years of development, in our patented ranking engine that looks at 38,000 funds, incorporates about 50 fund attributes along the risk-adjusted return, fees, duration. I mean, you name it, fund manager, tenure, tax efficiency. All of that is incorporated in determining what to sell and what to buy in which of these accounts. The ultimate goal is to give very clear, specific advice. And so there's a lot of heavy lifting that's going on behind the scenes. And as proud as we are of it, the service has been designed to not expose all of that unless people want it. It's been designed around giving them very clear guidance that they can get on with, and once they're comfortable, take action, make the trades, and as I mentioned, move on with their lives.
And in this action plan, when it comes to buying new investments, of course, Jemstep lists the investment that it's recommending.
Yep.
And then, well, I guess the first question, I think you've probably answered this, is Jemstep, as you said, tracks, I think you said 38,000 funds and ETFs. And I think you've also mentioned it sort of ranks those investment vehicles based on, I think you said 50 different factors?
Yeah.
Okay. I take it that is Jemstep constantly evaluating its ranking of investments, and are those changing from day to day or week to week or month to month?
So we gather data on a daily basis, and we run it through our data analysis, and then that is then applied to everyone's investments. But we're not changing recommendations on a daily or weekly basis. It's not a system that's designed to try and time the market or create a sort of rapid trading activity at all. The data is up to date, but the factors we look at are not driven by the day-to-day changes of the value or the returns. It's balancing, the long-term, medium-term, and short-term. And so the recommendations will adjust, but they don't adjust dramatically on a daily, weekly, or even monthly basis. And so we think of it as a strategic asset allocation and more of a sort of fundamentals-driven recommendation engine. And so that means it's always up to date, but it's not it's not changing its mind every week. If you follow what I'm saying.
I do, and the reason I brought this up is, and I'm looking at the recommendations now on the commodities. For the commodities asset class, the recommendation I'm seeing now is actually different than the recommendation when I first tried out the tool, probably 2 or 3 weeks ago. The recommendation now is the iPath S&P GSCI Total Return Index ETF, which is not one that I'm familiar with. But one of the things that Jemstep does is that, of course, I can make the decision to invest in that ETF, or I can look at other options. And when I click on the other buy options, Jemstep ranks the investing options. In this case, it's 1 through, I guess there's a total of 7 commodities ETFs and mutual funds that are recommended. And I guess this iPath is just the first one, again, based on fees and other things, as you've mentioned. I think it was the Power Shares, the ticker DBC, that was originally recommended. It's now fallen to 4th. So I take it, while it's not on a daily basis, there is some re-ranking of investment options that occurs periodically.
Absolutely, and I think there are a few things worth mentioning with that. Firstly, everyone has, as they've gone through life, they develop different preferences for funds. And what Jemstep's looking to be able to do is give, as you mentioned, a set of pre-screened funds, so maybe 7, as you mentioned, commodity funds, or 40 large cap options, perhaps more. But they're all pre-screened, one, to make sure they fit your profile and needs, and secondly, that they fit the requirements for our asset allocation. So if it's a large cap fund, these are funds that will replicate or come close to the index upon which our portfolios are built. So the list of funds you're given are already pre-screened, and they are quality funds. And then within that, we rank them, and typically within the first few, there's not necessarily large amount of difference in terms of the fit and the quality, but we endeavor to provide the one that comes out on top as the number one recommendation. But if you prefer, for example, Vanguard over iShares or Fidelity over Schwab Fund, you have the ability to then see other options, as you mentioned, and select the one that fits your particular preference. And so that's an important customization that's available to the individuals. And the third thing is, over time, we review our methodology, and as our thinking evolves or as there's new information, we may adapt the rankings for a specific asset class or a specific set of funds. And so those are also reflected over time within within the recommendations. And I'm not, I can't comment specifically on why those two funds traded places, but that's the methodology that we use to select them.
Does Jemstep have a bias towards value funds and ETFs?
Do we have a bias towards
the value investing versus growth?
No, we don't. In fact, for the service at this point, what we do is we have a bias towards broadly diversified mutual funds and ETFs, and so in essence, we're tending towards balanced funds that cover both growth and value side of the spectrum.
Right. One thing I noticed about the tool, and I guess this was only true if folks connect their investment accounts to Jemstep, but as you execute the recommendations, and in my case, there were a number of recommendations in my SEP IRA, which was all invested in individual stocks, and I've since sold all of them. I did that on I think Friday, with a plan to simplify my investments there and to buy into ETFs or mutual funds. But all of that showed up in the Jemstep tool. It had across the lines where it recommended I sell each of these investments. I forget exactly what it said, but it indicated that I'd taken that step. And so it kind of tracks your progress as you follow the recommendations, which I thought was nice. Helpful, because at least in my case, I've got a lot of work ahead of me, because like you mentioned earlier, I'm one of those people that my wife's got a 403B, I've got 2 401ks, I've got about 3 different IRAs, taxable accounts. After a while it gets complicated, and it is nice to see all of these recommendations, again, whether I follow all of them or some of them, effectively all on one screen.
No, firstly, Rob, it's great to hear that, and you're describing the prototypical Jemstep client where you're dealing with a lot of complexities, you're busy, and it's traditionally and typically been very hard to make sense and manage this in any systematic way, and we know that's the case. And so what we've worked pretty hard at and continue to work hard at and improve on is giving our clients kudos for the actions that they're taking that are, helping them towards a better outcome. And so we track the recommendations we've given, and we track the actions that are taken. And the way we do that is, as you mentioned, because the accounts are linked, and as those trades come in, we see them recognized and give a gentle pat on the back to help encourage you to take that next step. And that is a very important value within Jemstep. At the end of the day, nothing happens unless or until the client actually makes that trade, and we work hard to provide the means to do that, as well as the encouragement. And that's something that we track, analyze, and work towards helping investors take action on.
So once I take the recommendations, from Jemstep and execute on them, or whatever number I choose to. How does the tool help me after I've entered my portfolio, I've seen my asset allocation, I've seen Jemstep's recommended asset allocation, I've taken all of the recommendations or those that I choose to take. Does the tool help me after that? What can it do for investors after they've followed the recommendations?
Yeah, no, absolutely. You know, there were three things when we tested the service with a lot of potential clients, even when it was just on the equivalent of PowerPoint screens. And there were three things that really, really resonated. And the first was, I can see all of my accounts in one place, and you're going to make sense of them. That was huge. For many people, they'd never seen that. So seeing everything in one place was one thing. The second piece was, now I know what to do, which is you're giving me, as you mentioned, the buyers and the sellers in every account that are very explicit and that I can change if needed, was another huge value. And the third thing that rapidly followed after those first two was, but you're going to be there with me over time, right? And so the third thing relates to the service that Jemstep provides in keeping track of the portfolio over time, showing how you're on track towards the outcome you're looking for. And most importantly, as your circumstances change, as you perhaps add a spouse or add accounts or change jobs, automatically respond to that and update your plan around that. And so that's something that over time we're finding investors using on an ongoing basis. They update fairly regularly as things change and the plan is rerun. And the third is we have a regular quarterly rebalance. And so basically we set a timer. Once you've run your action plan, once you've run the system, we set a timer that automatically goes off in 90 days. Call it a quarter. And what it does is it says, is this investor on track for their target allocation? Are they within the parameters that we set? And so part of that is we look at what's the right allocation for them at the time, and we test their portfolio against that allocation. And if they need to make changes, we will send them an email, we will send them alerts within the service, and once again give them exactly the recommendations they need to take, the actions they need to take to make sure that they continue to be on track down the road. And so that is all part of the subscription. And in addition, we're continually reviewing the portfolio and looking for perhaps funds that are not great fits or that fees are too aggressive, and we'll make additional recommendations over time as to how the portfolio can continuously be improved and better optimized. And so that suite of services is provided as part of the subscription and provides that ongoing value to investors so that they continue using the service over time.
Well, and I tell you what, it's a good transition because you mentioned subscription, and I think it's good to talk about what this tool costs. And after our interview, but at the end of the podcast, I'll talk about a special offer that Jemstep was kind enough to extend to folks listening. But putting that aside, just can you give us an idea of how the subscription works and how much it costs folks to use the tool?
So Jemstep follows a what's commonly called a freemium model. So a good portion of the service is free to anyone using the service. And that is, in essence, everything all the way through to linking all your accounts, seeing them all in one place, and getting the projections for what you're on track for and how much better you might be able to do with an optimized allocation, optimized investments. And that is free. What the investors pay for are the specific recommendations. And that's a subscription service on a monthly basis with a upfront commitment. And the subscription is free for anyone under $25,000. And the short story there is the average American has less than $25,000 invested, and we wanted to make Jemstep free fully for them all the way through to the recommendations. So it's free up to $25,000, and then it's $16.99 for $25,000 to $150,000 in assets, and it scales up to $69.99 for assets over $600,000.
Okay, and it's a month-to-month subscription, although I think it's a 3-month upfront commitment. Is that right?
3-month upfront commitment, and then month-to-month, cancel at any time after the first 3 months.
And as I think you said, anyone, regardless of how much they have invested and want to link to Jemstep, they can use the tool for free up through the asset allocation. What they won't get are the specific recommendations.
Correct.
Well, okay, they'll need a subscription for that. Okay, well, listen, I really appreciate your time. I spent a lot of time looking at our investments. I've managed my family's investments for 20 plus years. I've read a lot, and I've had other folks. I've had folks from Fidelity on the show in the past. I had Rick Ferry on the show, who's an investing author. I was thrilled to have you on the show. I think this tool that Jemstep has created can help a lot of people. Particularly those like me that have accounts. You kind of wish you had your accounts just in one spot, but unfortunately with 401ks and IRAs, that's just not always possible. And so Jemstep helps bring it all together, which I can tell you has been a big help for me. So in any event, I really appreciate your time. Thank you for coming on the show.
Rob, thank you for having me, and it's great to hear you having a great experience with Jemstep, and for helping get the word out to individual investors who, at the end of the day, we're looking to support with a service, to help them make more informed investment decisions. So thank you for the opportunity.
Absolutely. And as I mentioned, I'll have links to the tool and other resources in the show notes to the podcast. Again, Simon, appreciate it. Thank you so much.
Thanks, Rob.
Well, I hope you enjoyed the interview, and if you want to check out Jemstep, you can do that, just jemstep.com. I'll have a link to it in the show notes. As I said at the beginning, I think it's a very interesting tool, very sophisticated, and I had a lot of fun working with it, and I didn't change my asset allocation plan dramatically because of the tool, actually not at all, but I did get some interesting ideas on investment options, and so I found it very helpful in that respect. And if you give it a try, I'd love to hear what you think of it. So if you give it a try, shoot me an email, dr@DoughRoller.net. Let me know what you think of it. That would be great. And so with that, brings our show to a close. As always, you can get the show notes at DoughRoller.net/podcast32. As I mentioned, email me. I love to get email. I read them all, respond to them all at dr@DoughRoller.net. Feel free to leave me a voicemail at speakpipe.com/DoughRoller. If you'd like to, you can subscribe to this podcast at DoughRoller.net/iTunes. That redirects you to the iTunes page where this podcast resides. And hey, I'd appreciate a review on iTunes. Love to get reviews. I know it takes a couple of minutes. I appreciate your time. Good or bad, I'd like to hear what you think. Helps me make the show better. And you can subscribe to our free weekly newsletter at DoughRoller.net/newsletter. Goes out every Saturday, packed full of resources and tips to help you make the most of your money. So with that, until next time, remember, the best thing money can buy is financial freedom.